Another one of the Wiley Plus assignments that I wanted to go over is this brief exercise 13. So we can see that they're issuing a 4-year note, $75,000, and it says it's zero interest-bearing note. And then it gives us the cash, so we don't have to solve for the present value. It gives us the cash receipt. And then it says the implicit interest rate is 12%. So again, we know in substance there's no such thing as a zero interest-bearing note because time is money. And so we're going to count for the note not at $75,000, but at this $47,664. So we debit cash for the amount received, and then we'll put the face amount in the note, and the difference is the discount. So when we go to the balance sheet, we're going to see a note payable for $75,000. And then we'll reduce that by the discount on notes payable for that $27,336. And so the net value, the net amount is $47,664. And all of that would get reported on the balance sheet. Okay, then that's on January 1, and then December 31st rolls around. So we will take the carrying value of that note, $47,664, and the implicit rate is 12%, and that will give us interest expense of $5,720. And so we record interest expense and reduce the discount. So after this is finished, we would have notes payable again, $75,000 on the balance sheet, but the discount would have gone from $27,336, and we would have reduced it by the $5,720 for a new balance of $69,280. So now the carrying value of the note is, oops, I said that all wrong. So I've come in and corrected that. So again, the note payable will stay at $75,000. The discount started at $27,336. We'll reduce it $57,20. So its new balance is $21,616. Then the carrying value, $75,000 minus the $21,616, gives us a carrying value of $53,384. So the carrying value is growing, isn't it? And eventually, by the end of the 4 years, the carrying value will be how much? $75,000. So at the end of the life of the note, the discount will zero out, and we will only have a balance in the notes payable. Okay, let's also look at brief exercise 14. So I'll let you read through that, and then I'm going to come back and we'll look at these entries. Okay, so they have exchanged a note for equipment, and if they had bought that computer, actually the computer elsewhere, they would have paid $31,495. So that is its fair value, if you will. So we're recording this asset received at the fair value, at its fair value. So remember back in chapter 12, actually I guess chapter 10, 11 and 12, we record long-term assets in an exchange at the fair value of whatever is received or given up, whichever is more reliable. So we know the fair value of the computer, and then the note, we put the face amount in that, and then we're plugging this difference to the discount. And so that note would have a carrying value of this $31,495. And so at the end of the first year, again, we have an applied rate of 12%. So we can calculate our interest expense. So we net these two together. These two accounts get netted together for a carrying value of this times 12%. That will give us interest expense of $3,779. So we record that as interest expense. In this particular problem, there actually is a cash payment of 5%. So $40,000 at 5% is a $2,000 cash payment each year. So this was a little unusual with that. So we have our expense, we have the cash payment, and the difference is plugged to the discount to reduce it. The other thing I want to add on here is that given we bought a computer, they're also at December 31st, we would need to make a journal entry for depreciation expense and also credit accumulated depreciation. So let's just assume that this equipment with a value of $31,495, so with the cost of that, let's say that it has a 5-year life. So let's just say it's 5-year life with no salvage value. So that's going to give annual depreciation expense of $62.99. And so I just want to add that in because really we bought a computer with debt. So we made the adjusting entry relative to the debt, but there also would have been an adjusting entry for the computer itself and its depreciation.